Your market news now. Stocks in Asia struggled for momentum as a rally in China took a breather. Traders held on to Fed rate cuts for this year, even after U.S. inflation came in higher than expected. Locally, Growthpoint Properties expects its distributable income for this year to be lower due to high interest rates, while the impact would likely be more weighted across its businesses in the second half. The property developer said distributable income per share, which is the primary measure of underlying financial performance in the listed property sector, is expected to decline by between 10 and 12% for the year. To give us perspective on the markets, we are joined by Chantel Marks, who is from F&B Wealth and Investment. Chantel, thank you so much for your time. I mean, given the fact that we've gotten that US CPI inflation figure, I'm curious as to the market reaction and currently what's driving markets.
Well, the market reaction has been meh. There has been absolutely no reaction from the markets on the back of that hotter than expected print. And one of the reasons, I think, is because it's not the print that the Fed uses in order to make decisions around monetary policy and the interest rate trajectory. The Fed looks at a print called the PCE, or the Personal Consumption Expenditure Index, and that really is what are people spending their money on, because the inflation basket is quite static, which means that the inflation basket can move up, but people could be avoiding purchases of more expensive goods, for example. Some of the things that were driving the inflation in this period won't be in the personal consumption expenditure basket, and for that reason, it's very difficult to say whether or not this will kind of translate into what's in there and will factor into the Fed's decision in the first place. I think the overarching feeling as well is that this is a little bit hotter than expected, but it's by no means a blowout. And the market sentiment is generally quite greedy at the moment, so investors shrugging off that print.
All right, let's bring things locally for a bit. I mentioned in my intro that Growthpoint reported their numbers. What did you make of Growthpoint's earnings, but also as well as their expectations for the first 6 months of the year?
So Growthpoint did reasonably well considering the environment that they're operating in, and particularly their exposure to the office space. Areas for Growthpoint that did particularly well was, for example, the V&A, benefiting from really strong consumption growth, both from domestic and international consumers that frequent that specific establishment. Bragged on their numbers was, as I mentioned, the office space as well as their Australian business. Now, looking ahead, they still expect a distributable income per share to come under pressure. But importantly, they actually narrowed their guidance for the better. So they expect distributable income per share to fall by between 10 and 12%. Previously, that guidance was for 10 to 15%. So I think overall, a better than expected outlook and a pretty solid set of numbers given the operating environment.
I want to tie that to the trading update that we got out of Hyprop, because for some reason, given that share price reaction, I think it was down 7% at some point, it's almost as though the market has woken up to some of the risks around Pick and Pay, and now everyone's looking at the other REITs and looking at their actual footprint and what's happening in their retail spaces. What did you make of that trading update?
Yes, so I mean, that was very much the stat kind of line in the Hyprop trading update. And it was the first of the REITs to actually mention Pick and Pay as an anchor tenant in many of their retail centers as a key risk to the outlook for the stock. They went so far as to withhold the interim dividend. Well, that is not the only reason. It is a contributing factor to why Hyprop feels better about retaining cash at the moment. So I do think that this is an issue that REITs are specifically focused on at the moment. But I would tie that back to a few years ago where we had the same scenario play out with Massmart. And at the time, most of the REITs were actually mentioning what their exposure was to Massmart retailers, particularly the struggling ones being Game and Dion Wired. And if you think back to Dion Wired, that actually ended up closing many of their stores, and those were big box stores, a lot of them were actually in high props properties. So this management team has been burnt by something like this in the past, and I think that they're just trying to be as cautious as possible with their approach.
What's your assessment of local equities, given that, the hurdle rate for investing in equity seems a bit higher right now? I mean, if you look at what you're getting from the strong yields, 11% on bonds, some may argue whether there's actually a reason to look at equities right now. What's your view?
Yeah, so certainly I think from a risk return perspective, the next few months are going to be quite difficult for the equity market, particularly because the bond market looks so attractive. And we do have a lack of interest in the local equity market, both from local investors as well as offshore investors. We have to think about what is going to change that. And I think that after the election, you will have a calming down of fears around that specific political risk that is playing out in May. And that could see both local investors and particularly international investors feeling more confident about investing in SA assets. The initial gains, I guess, will be made on the fixed income side. But from a long-term investment perspective, your gains will be much better on the local equity market, particularly given how subdued our valuations are at the moment. So I think the investment case is there, but it could be a wobbly ride for the next 4 or 5 months.
Just quickly, before I let you go, is there a reasonable risk that the Fed may not cut this year?
There is certainly a risk. There's always a risk. But in terms of what the Fed has said and the rhetoric at the moment, I think it's a low-risk event. Inflation is quite sticky at the moment, but it is on a downward trajectory. I do think that some of the things in the headline CPI readings and the core CPI readings we saw yesterday won't translate into the personal consumption expenditure index. Yeah. And I don't think that they would want to stoke fear in the market by deviating from their stated path.
All right, Chantal, thank you so much for your time. That is Chantal Marks, who is from FNB Wealth and Investment. And now that we've gotten that CPI data, as I mentioned, the next economic data of focus is going to be PPI, retail sales, as well as consumer sentiment, which we are going to be watching closely. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.